There is a particular kind of American, disciplined, skeptical of institutions, deeply suspicious of paper promises, who looked at the trajectory of this country's fiscal policy sometime in the last decade and made a quiet, private decision. They did not call a broker, they did not open an app. They drove somewhere, or typed into a search bar, and they bought silver. Physical silver, the kind you can hold in your palm, the kind that has no counterparty risk, no CEO who can mismanage it, no Federal Reserve chairman who can dilute it overnight with the stroke of a digital pen. They bought it because the dollar felt like a rounding error waiting to happen. They bought it because they watched grocery prices climb month after month with the mechanical indifference of a tide. They bought it because they had read enough history to know that every fiat currency ever issued by every government in the recorded sweep of civilization has eventually returned to its intrinsic value, which is precisely zero. And so they stacked. Quietly, patiently, with a kind of righteous, self-reliant confidence that is among the most classically American of impulses. Here is what they did not know. The Internal Revenue Service was waiting for them, not with urgency, not with drama, with the perfect, unhurried patience of an institution that knows it will collect eventually, because the law is already written, the code is already in place, and the only variable is time. As of this week, silver is trading near $66 per ounce, a figure that would have seemed extraordinary to anyone who bought in the mid-range years. Silver hit a nominal all-time high of $121.67 per ounce on January 29, 2026, and even at today's pulled-back levels, it remains more than 80% higher than it was just 1 year ago. Those are real gains, life-changing gains for some. The kind of gains that make a decade of patient accumulation feel vindicated, justified, even triumphant. And they are the kind of gains that bring a man or woman to a dealer's counter, check in hand, with a feeling of quiet satisfaction, right up until the moment the tax bill arrives. What follows is not a story about punishment. The IRS is not punishing silver stackers. It is doing something far more instructive. It is revealing the distance between what most Americans assume about financial regulation and what the law actually says. That distance in 2026 is wide enough to drive an armored truck through, and the people who discover it too late are not, as a rule, the careless or the naive. They are precisely the careful ones, the planners, the readers, the people who did their homework on silver but never thought to do their homework on what happens when you sell it. The foundation of everything that follows rests on a single, largely unknown fact about how the federal government classifies physical silver. Most Americans who have held stock for more than a year understand, at least vaguely, that long-term capital gains receive preferential tax treatment. The standard long-term rate for most earners is 15%. For higher earners, it rises to 20%. People plan around these numbers. They do the arithmetic in their heads, subtract a reasonable percentage from their profit, and feel adequately prepared. Physical silver is not a stock. The Internal Revenue Code classifies it as a collectible, the precise statutory word, carrying the same taxonomic weight as fine art, antiques, rare wine, and vintage automobiles. And collectibles have their own federal long-term capital gains rate, one that has existed quietly in the code for years while most investors remained blissfully unaware of it. That rate is 28%, not 15, not 20, 28. For the stacker who held silver for years and sold near the peak, that is nearly double what they budgeted for, and it is only the beginning of what they owe. The nuance the IRS adds, and there is always a nuance, is that 28% is the maximum collectibles rate, not an automatic floor. If your ordinary income rate sits below 28%, you pay the lower of the two. But here is the architecture of the trap. Silver gains are added to your total income for the year before that calculation is made. A large silver sale does not sit beside your income. It stacks on top of it. The sale itself is the mechanism that lifts you into the bracket. You become liable for the higher rate precisely because you sold. And if you held your silver for a year or less, if you bought during the run-up and sold quickly, which many did, short-term gains are taxed as ordinary income, potentially at 22, 24, 32, or even 37%. Selling silver you acquired recently may be one of the single most expensive financial transactions available to an ordinary American, and most of those making it have never been informed of that fact. The IRS is not going to call you and explain this. That is not how the institution operates. It will wait. It will let you sell. It will let you cash the check and deposit the money and perhaps spend some of it. And then it will send you a bill, accompanied by no apology and no acknowledgement that a reasonable person might have assumed otherwise. If you are a silver stacker in America right now, and this is the first time you are encountering this information, you are not alone. You are, in fact, the rule rather than the exception. And what you do next, whether you dismiss this as abstract or sit with it long enough to understand what it means for your specific position, is the most consequential financial decision you will make this year. Stay with me. Because what 2026 specifically added on top of the existing rate is something the financial press has largely failed to cover with the seriousness it deserves. The year 2026 arrived with two changes to the regulatory landscape surrounding precious metals that the silver stacking community, for all its collective vigilance about monetary policy and government overreach, largely failed to see coming. Both changes are real, both are documented, and both illustrate a governing principle that anyone who has watched Washington long enough eventually internalizes. The most consequential alterations to the rules are rarely announced with fanfare. They arrive in footnotes, in revised instructions, in the quiet administrative language of federal forms that almost no one reads until something goes wrong. The first change came from the IRS itself. On February 10, 2026, the agency revised the instructions for Form 1099-BA, the form that documents proceeds from broker and barter exchange transactions, specifically removing an example from the section governing precious metals dealer reporting. Describing this as a clarification is accurate in the narrowest technical sense and deeply misleading in every meaningful practical one. What the revision accomplished was this: it established explicitly that when a dealer determines whether a reporting threshold applies, sales to a single customer within a 24-hour window must be aggregated and treated as a single transaction. If you sell 100 ounces in the morning and another 100 in the afternoon, the IRS now sees that as 200 ounces sold in a single event, for purposes of determining whether a report is filed. The people who are most affected by this change are precisely the people who were most aware that dealer reporting thresholds existed and were managing their transactions accordingly. The IRS, which has been watching this behavior long enough to model it, has now codified a rule that forecloses the strategy. It is worth pausing on this for a moment, not to assign moral judgment, but to appreciate the institutional sophistication involved. The aggregation rule does not accuse anyone of wrongdoing. It simply closes a door that a certain category of informed seller was using without ever announcing that the door was being closed. The second 2026 change came at the state level, and it is a signal that anyone paying attention to fiscal trends across the country should read carefully. Washington State eliminated a precious metals tax exemption that had been in place for decades, meaning that beginning January 1, 2026, Washington buyers pay full retail sales tax on every silver and gold purchase. The combined rate, depending on the county, runs between 6.5% and 10.3%. A Washington resident buying $10,000 in silver now pays up to $1,030 in sales tax on the purchase alone, before a single cent of gain is realized, before the federal rate enters the picture, before anything else happens at all, just on the front end. Washington is not an island. Maryland taxes all bullion at 6%. Vermont applies a 6% purchase tax and then levies state income tax on gains, a double imposition that requires no commentary to appreciate. Maine applies 5.5% with no exemptions. California, in its characteristically Byzantine fashion, exempts only purchases above $2,000, which means the small stacker buying a few ounces at a time is taxed on every single transaction, while the larger buyer escapes. The legislative direction being set here is not subtle, and every other state capital in the country is watching what Washington has done. But it is the Medicare dimension of this story that may be the most quietly devastating and the most cruelly ironic, of all the elements in play. There exists a mechanism within the Medicare system called the Income-Related Monthly Adjustment Amount, known by the acronym IRMAA. The mechanism works as follows. Medicare examines your income from 2 years prior to determine your current premium surcharges. The standard 2026 Part B premium is $202.90 per month. That is the baseline for most enrollees. But for those whose income crosses certain thresholds, the surcharges activate. For a single filer, they begin when modified adjusted gross income exceeds $109,000. For married couples filing jointly, the threshold is $218,000. Now consider the retired silver stacker. He is in his late 60s. He has been accumulating for 12 years. He decides this year, with silver having run so dramatically, to liquidate a meaningful portion of his position. The gain is large enough to push his income for the year above one of the IRMAA thresholds. He pays his taxes, he moves on, he forgets about the silver sale, and then, 2 years from now, his Medicare statement arrives, and the premium is substantially higher. The IRMAA surcharges in 2026 range from $1,148 to $6,936 per person annually. For a married couple, both on Medicare, both crossing the threshold from a single silver sale, the additional cost can exceed $13,000, collected not in April, not in the year of the sale, but 2 years later, attached to no explanation that connects it to a silver transaction that the seller has long since ceased to think about. The IRS did not design IRMAA to trap silver stackers. It designed IRMAA to make Medicare solvent on the backs of higher earners. But the effect on the retiree who sells silver without understanding the mechanism is identical whether the trap was intentional or incidental. He pays, and he pays twice, once to the IRS in the year of the sale, and once to Medicare 2 years later in a bill he cannot easily explain and could not have anticipated without specific, targeted foreknowledge. This is precisely why the people who get hurt the worst in this scenario are not the reckless ones. They are the disciplined ones, the ones who saved, the ones who planned, the ones who chose an unconventional asset precisely because they understood correctly that conventional assets carry their own species of risk. The irony is not small. The stacker bought silver to escape the system's machinery. The system's machinery was waiting for the moment he tried to convert that silver back into dollars. And it has been waiting patiently, with compounding interest, for years. If you find yourself nodding at any of this, if any piece of what you've just heard landed differently than you expected, then do something concrete with that feeling right now. Subscribe. Not because more content is inherently valuable, but because what comes in the weeks ahead builds directly on what you are learning right now. The people who protect their wealth are the ones who keep learning before the bill arrives, not after. Hit that subscribe button. This is the conversation your financial advisor probably has not had with you, and it is not finished yet. There is a man, call him representative of a category, because he represents thousands, who did everything right. He researched silver. He bought on dips. He kept his stack secure. He built his position over more than a decade with the patience of someone who genuinely understood that wealth preservation is a marathon and not a sprint. He accumulated roughly $80,000 worth of silver at current prices. When the price ran, he made the entirely rational decision to take some profit. He sold. He collected his payment. He budgeted for taxes. Generously, he thought. He expected a bill somewhere in the neighborhood of $12,000. His actual tax liability came back at $23,000. The gap between what he expected and what he owed was $11,000, not because he was dishonest, not because he failed to report the sale, not because he tried any maneuver that a reasonable person would recognize as aggressive. The gap existed because he had no documentation of his cost basis for metal purchased years earlier at coin shows and through smaller dealers. No receipts, no invoices, no records establishing what he paid per ounce at the time of purchase. In the absence of that documentation, the IRS does not assume a generous cost basis. It has no reason to. And so his preparer, working conservatively and correctly, treated a larger portion of his proceeds as taxable gain than the economic reality justified. The gain looked bigger than it was. The bill grew accordingly. The cost basis problem is, in many respects, the most preventable catastrophe in all of silver taxation. When you sell silver at a gain, you owe tax not on the full sale price, but on the difference between what you received and what you originally paid. If you bought at $20 an ounce and sold at $66, your taxable gain is $46 per ounce, not $66. That is the number the rate applies to. The distinction matters enormously at scale. But if you cannot prove what you paid, the IRS does not split the difference with you. It works from what can be verified. And if nothing can be verified, the burden falls heavily on the seller. In 2026, this problem acquired a new and specifically technological dimension. The updated Form 1099-B instructions now require dealers, in applicable circumstances, to attempt to report the seller's cost basis alongside the sale proceeds. The IRS automated matching system receives that figure. It compares it to whatever your tax return says. If the numbers diverge, the mismatch is visible, not to a human reviewer, not initially, but to a computer running comparisons across millions of transactions simultaneously, every day, without fatigue, without error, and without mercy. A discrepancy triggers a CP 2000 notice. That notice is not a criminal accusation. It is simply the agency's way of saying that its records and your records do not agree, and it would like an explanation. If the explanation is unsatisfactory or unavailable, the consequences compound with interest and penalties reaching back 3 to 6 years. And then there is the dimension that the silver community most consistently underestimates: the digital reporting trail that has nothing to do with dealers at all. If you have sold silver through eBay, through an online marketplace, or through peer-to-peer payment platforms like PayPal or Venmo, those transactions have generated Form 1099-K reports that flow directly to the IRS, not from any coin dealer, but from the payment platform itself. The IRS is not relying on a single reporting stream. It has 3 running simultaneously: Dealer 1099-B forms, Platform 1099-K forms, and bank currency transaction reports and suspicious activity reports for large cash movements. All three feed the same automated matching engine. The stacker who treats online silver sales as private transactions is operating on an assumption about data opacity that the current regulatory infrastructure simply does not support. Against all of this, there exist legal, IRS-sanctioned strategies that can meaningfully reduce the damage, but every one of them requires planning before the sale, not regret after it. The most powerful tool available is the self-directed Roth IRA, which permits physical silver meeting a minimum fineness of 0.999 to be held inside a retirement account, provided proper custodial arrangements are maintained. Inside a Roth, the 28% collectibles rate does not apply to growth. Qualified distributions in retirement are tax-free. Silver that doubles inside a Roth generates no capital gains liability whatsoever. Zero. This is not a loophole. It is a deliberate provision of the tax code, available to virtually anyone with earned income who plans ahead. Timing matters with equal force. Spreading silver sales across multiple tax years, rather than liquidating a substantial position all at once, can keep annual income below the brackets and IRMAA thresholds that trigger the most severe consequences. A stacker with flexibility in when they sell, and many retirees have precisely that flexibility, can manage their income profile with surprising effectiveness if they begin planning early enough. Product selection carries its own relevance. American Silver Eagles, because of how they are listed in the IRS reportable items framework, do not automatically generate a Dealer 1099-B filing regardless of quantities sold, reducing the automated reporting footprint on those specific transactions. And for seniors who can afford to hold their silver until death, the step-up in basis provision eliminates a lifetime of embedded gains entirely. Heirs receive the metal with a basis reset to fair market value at the date of death. $46 of gain per ounce, built patiently over a decade, simply vanishes, legally, permanently, by explicit congressional design. None of this is complicated to understand. All of it is complicated to execute without guidance. Which is why the single most important piece of advice in this entire discussion is the simplest. Before you sell a meaningful silver position, retain a CPA who has specific experience with precious metals transactions. Not a general preparer, not tax software. A professional who understands bracket management, IRMAA thresholds, holding period mechanics, cost basis documentation, and the rules governing inherited and gifted metals. The difference between a generic return and one prepared with actual expertise in this area is frequently larger than the professional's fee. The man who received the $23,000 bill when he expected 12? A knowledgeable professional engaged before the sale, not after, could have identified timing strategies, located or reconstructed documentation, and potentially saved him thousands of dollars through planning alone. He made no illegal moves. He made no ethical failures. He simply did not know the rules, and the rules did not wait for him to catch up. Silver, as an asset, has earned its place in the portfolios of serious, thoughtful Americans. The supply picture is real. The industrial demand is real. The monetary case is real. Supply deficits, explosive industrial demand, and safe haven investment driven by geopolitical tensions have all contributed to a market that rewarded patience at a scale few anticipated. But real assets come with real tax rules, constructed by a real institution that has been building this framework methodically, deliberately, and without any obligation to inform you of its contents before you trigger it. The whole point of owning silver, the philosophical foundation upon which the entire stacking movement rests, is to protect what you have built, to hold something real against a world of paper promises and institutional uncertainty. Do not hand that protection back to the Treasury because you did not plan the exit. The government did not print silver. You bought it. You held it. You deserve to keep what you earned from it, and the only way to do that is to understand the rules before the transaction is complete. Now here is what I want from you, because this conversation matters more than any single video can contain. Drop a comment right now and tell me which layer of this story surprised you most. Was it the 28% collectibles rate that almost nobody knows about? Was it the IRMAA Medicare surcharge that arrives 2 years after the sale? Was it the Washington state exemption being erased after 4 decades? Was it the digital platform reporting trail that bypasses dealers entirely? Or was it the cost basis trap, the documentation problem that can transform a real gain into a phantom one on paper? Tell me, specifically, because the answer you give tells me exactly which conversation we need to have next, and that next conversation may be worth more to your financial situation than anything else you do this year. And remember, this is for education and discussion only, not personal financial advice.